Today, we're breaking down Bitcoin ETFs, what they mean for price and adoption. Welcome to Bitcoin Bytes HQ, simple Bitcoin explainers. This is educational content only, not financial advice. Let's go. Bitcoin ETFs matter right now because they change how people can access Bitcoin without changing how Bitcoin itself works. For many people, buying and securing Bitcoin directly still feels confusing or risky. ETFs offer a familiar wrapper inside traditional financial accounts. That convenience draws attention and sometimes leads people to overestimate its impact on Bitcoin. At the most basic level, a Bitcoin ETF is a financial product that tracks the price of Bitcoin. Instead of holding Bitcoin yourself, you buy shares that represent exposure to Bitcoin's price. Those shares live inside brokerage accounts, retirement accounts, and portfolio dashboards people already use. For someone who has never touched self-custody, that familiarity lowers the barrier to entry. Here's an important clarification. Under current rules, when new shares of a spot Bitcoin ETF are created, the fund must buy real Bitcoin and hold it in custody to back those shares. The ETF cannot create Bitcoin out of thin air. It must be backed by actual coins. The Bitcoin exists on-chain, but the custodian holds it, rather than the investor. That means ETFs can create real buying pressure in the market, but it's important to be precise. ETFs don't create Bitcoin. They don't set the rules. They interact with the existing supply. Bitcoin's supply is fixed. There will only ever be 21 million Bitcoin. That rule doesn't change when a new financial product is introduced. So when more people want exposure, whether through ETFs or direct ownership, they are competing for the same scarce asset. Over time, sustained demand for something scarce tends to push prices higher, even though short-term moves are still driven by expectations and market conditions. Wider participation can also affect how Bitcoin trades day to day. As more buyers and sellers enter the market, liquidity can increase. That may smooth some short-term volatility without eliminating it entirely. Bitcoin's fundamentals stay the same, but the market around it can behave differently. This brings us to adoption. Adoption doesn't only mean individuals holding their own keys. It also means Bitcoin becoming legible to existing institutions. ETFs allow Bitcoin to plug into systems like retirement accounts, compliance frameworks, portfolio allocation models, and even official government reserves. The underlying asset doesn't change, but the interface does. Think of it like water. Early users had to dig wells themselves. Later, they could turn on a tap and access the same water from a shared system. The water itself didn't change, just the way people could use or access it. Underneath all of this, Bitcoin still runs on nodes. A Bitcoin node is software that independently checks the rules of the network. Bitcoin Core is the reference implementation most people use, but alternatives like Bitcoin Knots exist as well. What matters isn't the brand of software. What matters is that thousands of independent users are verifying the same rules. Nodes are like referees following a shared rulebook. They don't care who owns the most Bitcoin. They don't care how Bitcoin is packaged on Wall Street. They only care whether the rules are being followed. With that foundation in place, let's look at where people often get this wrong. One common myth is that whoever holds the most Bitcoin controls Bitcoin. You'll often hear this applied to large companies, well-known individuals, asset managers behind ETFs, or even governments. The idea feels intuitive. If someone owns a lot, it seems like they must have power over the system. But Bitcoin doesn't work that way. Ownership does not equal control. Large holders can influence markets through buying and selling, but they cannot change Bitcoin's rules. They can't raise the supply cap, reverse transactions, or decide which payments are valid. That authority comes from rule enforcement, not balance size. Think of Bitcoin like a public language. You can speak it loudly or quietly, but you can't rewrite the grammar. Nodes enforce the grammar. Everyone else has to follow it, no matter how large they are. Another misunderstanding is that ETFs guarantee higher prices. It sounds logical. More money flowing in should push prices up. But markets don't move in straight lines. Prices reflect expectations, timing, and broader conditions. ETF inflows increase participation, but they don't remove risk or volatility. They create a new on-ramp, not a permanent price floor. A related concern is often called paper Bitcoin, and it's broader than ETFs alone. When people use this term, they're usually pointing to financial markets that allow price exposure without owning or settling real Bitcoin on-chain. This includes futures, options, and other contracts that allow both long and short positions. These markets can influence price discovery, especially in the short term, but they don't change Bitcoin's supply or its rules. Only on-chain settlement does that. Some people confuse infrastructure with income. Running a Bitcoin full node is not a way to make money. A node exists to verify rules and protect your ability to independently check the system. Even with Lightning routing fees, running a node is not a reliable income strategy. Infrastructure provides resilience and verification, not guaranteed returns. What I wish I knew when I started is that ETFs are not Bitcoin without trade-offs. I assumed that price exposure and ownership were basically the same thing. That assumption made financial products feel more powerful than they actually are. The insight that corrected this was learning how verification works. Once I understood that nodes independently enforce Bitcoin's rules, everything clicked. ETFs and financial markets sit on top of Bitcoin. They rely on the network, but they don't replace self-custody or the ability to personally verify Bitcoin yourself. They add convenience, not sovereignty. Here's the expanded picture. Bitcoin is like a public utility with transparent rules. Anyone can inspect how it works, and anyone can verify that those rules are followed by running a node. Financial products, like ETFs, are service layers built on top of that utility. They serve people who prefer simplicity and institutional custody, while the base system remains open to anyone who wants direct control. Verification is the quiet backbone. Nodes keep the rules consistent. Privacy depends on how you interact with the system. Decentralization survives as long as individuals retain the ability to verify independently. ETFs may change who holds exposure, but they don't change why Bitcoin works. Here's a simple next step, is to think about what matters to you: direct ownership and verification, or convenience and institutional custody. That's Bitcoin ETFs simplified. If this helped, like, share, and subscribe for more Bitcoin explainers. Drop your biggest takeaway in the comments. I'd love to hear your thoughts. See you in the next one.